Can't qualify for a traditional mortgage loan, but you own and operate your own business? A bank statement loan may actually be the solution for you. Welcome to The Mortgage Mindset. I'm your host, Trevor Otsuka. I am a multiple state licensed mortgage advisor with Streamline Home Loans out of Las Vegas, Nevada. And my goal on this show is to be an educational resource for you, teaching you everything that you need to know about various loan programs and real estate. All of my contact information can be found in the video description below. Please don't hesitate to reach out should you need assistance with a refinance or a purchase, and I will be more than grateful to help you out. If you find this video content of value, please share the show, like it, subscribe to it, and let's get started. So you can't qualify for a traditional mortgage loan that requires stringent income documentation. You own your own business. Your CPA is a gangster, and they drastically reduce your tax liability at the end of the year through business write-offs. And now, on paper, it appears as though you make very little to no income. So how can you buy a house without the need for hard money or doing a straight up all cash purchase? A bank statement loan could be the solution that you need. So what is it? A bank statement loan is a non-qualified mortgage or non-QM loan. Here's a link to a previous video where I explained to you exactly what a non-QM loan is. Instead of requiring full tax returns and W-2s and pay stubs, we will use your bank statements from your business or businesses to generate a monthly income number for you. You're going to provide anywhere from 12 up to 24 months of your business bank statements. We will review all of the deposits that have been made into your business bank account from the statements that you provide us, and you're actually allowed to provide up to 3 different businesses and 2 different accounts for each business. The catch to this is that the deposits into these accounts have to be original deposits. They can't be wire transfers from, say, your personal account into the business. We're not going to count those as qualified income that is derived from business operations. The income itself will be calculated in one of 3 different ways. The most common way is called a fixed expense. To give you an example of this, it's going to depend on the nature of your business. If your business is services-based or if it's product-based, will make a difference. And they also take into consideration the total number of employees that you have in your business. If you're in the services business, then obviously the more employees that you have, then the greater expense that you have because of payroll, and they will hit you with a larger fixed expense ratio that could be all the way up to 50% of your annual income from the business. Meaning if you make $500,000 in your business with the 50% expense ratio, they're going to say you only make $250,000 from your business. If you're a product-based business, this actually could significantly go up. I've seen some investors that will use the fixed expense ratio for product businesses with 5 or more employees all the way up to 80%. The second method that they will use is called a profit and loss statement. I'm sure a lot of you business owners know exactly what a P&L is, and the P&L will typically have to be third-party prepared from your CPA, your tax preparer, your EA, etc. So they'll take all of the gross deposits from the 12 or the 24 months, they will subtract out the expenses from the P&L, and then they will multiply it by your percentage of ownership of the business. And that's how they pretty much come up with your net income. The last way that they will calculate your income is called an expense summary. And this one's pretty straightforward. You're going to get a letter from your CPA or your tax preparer that states what your expense ratio is as a fixed percentage of your gross earnings from the year. I highly encourage you to speak with your mortgage advisor so they can tell you exactly what the guidelines are from the investor. Some investors will actually allow you to use as little as 10% for your expense ratio if you can go this direction. Now, the letter, again, has to come from a third-party prepared CPA or tax preparer, and there's definitely going to be some additional documentation that we will need from your tax preparer to make this work. My personal recommendation is definitely the third option if you have a tax preparer that is willing to assist you with the documentation requirements. This program obviously is most beneficial for self-employed business owners that have a significant amount of tax write-offs on their Schedule C or on their K-1s. Be sure to contact me for any specific scenarios that you'd like to run through and to get started on your pre-approval process. That's it for this week. I want to thank you again for tuning into another episode of The Mortgage Mindset. Like it, share it, subscribe to it, and I will see you all next time.